Dear students, welcome to my channel, Dr. V.R. Pudile, Professor of Management and Economics. In this video, I am dealing with different long-term sources of finance, including equity shares, preference shares, retained earnings, bonds or debentures, term loans, venture capital financing, and international funding. Long-term sources of finance. The long-term sources of finance fulfill the financial requirements of an enterprise for a period exceeding 5 years and more. According to World Bank, long-term source of finance can be defined as any financial instrument with maturity exceeding 1 year. Maturity refers to the length of time between origination of a financial claim and the final payment date. Equity, which has no final repayment date of a principal, can be seen as an instrument with non-finite maturity. Long-term sources of finance can be used for purchasing fixed assets, to finance permanent part of working capital, and to finance the growth and expansion of business. In this figure, I had explained different long-term sources of finance. Long-term sources of finance can be divided into different types. They are 1. Equity share, 2. Preference share, 3. Retained earnings, 4. Bond or debenture, 5. Term loan, 6. Venture capital funding, and 7. International funding. Let us now deal with long-term sources of finance in detail. 1. Equity share. Equity share represents the ownership of a company. The capital raised by issue of equity shares is known as ownership capital or owners' funds. Equity shareholders collectively own the company. They bear the risk and enjoy the reward of ownership. Their liability is limited to the extent of capital contributed by them in the company. Every shareholder is entitled to a return on shares, which is known as dividend. Dividend depends upon the profits made by company. Higher the profits, higher will be the dividend, and vice versa. Equity shares are attached with certain rights. Equity shareholders have the right to receive dividend, right to vote, the right to attend meetings, and the right to inspect the books of account. Equity capital serves as permanent capital, as it is to be repaid only at the time of liquidation of a company. Equity shareholders are given benefit of rights issue. When the company makes fresh issue of shares, it has to offer first to the existing shareholders in proportion to their existing shareholding. If they do not take up, the same can be issued to others. The second long-term source of finance is preference share. The capital raised by issue of preference shares is called preference share capital. The preference shareholders enjoy a preferential position over equity holders in two ways. One, they have preferential right to be paid dividend during the lifetime of the company, but the dividend is fixed on preference shares. And two, they have preferential right to return the capital when company is liquidated. Preference shares have some common characteristics of both equity shares and debentures. Preference shares resemble debentures as they bear fixed rate of return. Dividend is payable only out of profit after tax. To that extent, these resemble equity shares. Preference shareholders generally do not enjoy any voting rights. Preference shares may be cumulative or non-cumulative. Preference shares may be callable or non-callable. Preference shares may be convertible or non-convertible. The third long-term source of finance is retained earnings. A company generally does not distribute all its earnings to the shareholders as dividends. A portion of the net earnings may be retained in the business for use in the future. These are known as retained earnings. These are source of internal financing or self-financing or ploughing back of profits. Retained earnings in an organization depends on many factors like net profits, dividend policy, and age of the organization. The fourth long-term source of finance is bond or debenture. Bond or debenture is a debt instrument for raising long-term capital. A company can raise funds through issue of bonds or debentures which bear a fixed rate of interest. The bond or debenture issued by a company is an acknowledgement that the company has borrowed a certain amount of money which it promises to repay at a future date. In other words, a bond or a debenture is actually a certificate proving the contract of indebtedness of the issuing company to its holders. Bonds are secured by a physical asset. On the other hand, debentures are unsecured debt instruments that are not backed by any collateral. Most important features of bond or debenture include nominal or principal or face amount, issue price, maturity date, coupon rate, coupon date, and indenture and covenants. Nominal or principal or face amount refers to the amount on which issuer or company pays interest. Issue price is the price at which bond or debenture is sold to investors. Maturity date refers to the date on which issuer or company repay principal amount to the investor. Coupon rate is the interest rate that the company or issuer pays to bond or debenture holder. Coupon date is the date on which interest is paid to investor. Indenture is debt agreement and covenants are clauses of it. The fifth long-term source of finance is term loan. The term loan is a long-term secured debt extended by banks or financial institutions to the corporate sector for carrying out their long-term projects maturing between 5 to 10 years, which is normally repaid in monthly or quarterly equal installments. They are an external source of finance paid in installments governed by loan agreement and covenants. The term loan is acquired for new projects, diversification of business, expansion projects, or for modernization or for technology upgradations. Lack of option of funding from other sources such as equity for any reason also directs a company to go for the term loan. At times, an important reason for selecting term loan is financial leverage. The sixth long-term source of finance is venture capital funding. Venture funding is a funding process in which the venture funding companies manage the funds of the investors who want to invest in new businesses which have the potential for high growth in future. The venture capital funding firms provide the funds to startups in exchange for the equity stake. Such a startup is generally one that possesses the ability to generate high returns. However, the risk for venture capitalists is high. There are 5 stages in venture capital funding, including seed capital, startup capital, early or second stage capital, expansion stage, and bridge or pre-IPO stage capital. The seventh long-term source of finance is international funding. With the opening up of an economy and the operations of the business organizations becoming global, Indian companies have an access to funds in global capital market. Various international sources from where funds may be generated include commercial banks all over the world, international financial institutions including International Financial Corporation (IFC), Exim Bank, and Asian Development Bank, and international capital market instruments including Global Depository Receipts known as GDRs. Let us now understand about Global Depository Receipts GDRs. The local currency shares of a company are delivered to the depository bank. The depository bank issues depository receipts for these shares, and such depository receipts denominated in US dollars are known as Global Depository Receipts or GDRs. GDR is a negotiable instrument and can be traded freely like any other security. In the Indian context, a GDR is an instrument issued abroad by an Indian company to raise funds in some foreign currency and is listed and traded on a foreign stock exchange. The holders of GDRs do not carry any voting rights but only dividends and capital appreciation. Many Indian companies such as Infosys, Reliance, Wipro and ICICI have raised money through issue of GDRs. Dear students, in this video I had dealt with different long-term sources of finance. Thank you.